Okay, so you want to own a self-storage facility. Here's the pitch, and it's almost insulting how simple it is. You buy a plot of land, you build a bunch of metal boxes with roll-up doors, and then you wait for humans to do the one thing humans are evolutionarily incapable of not doing: accumulating stuff they don't need and refusing to throw it away. No plumbing, no kitchens, no customer service drama, just steel, concrete, and a padlock. It sounds less like a business and more like a vending machine for guilt. And weirdly, the pitch basically holds up. This is one of the only businesses in the world where the product doesn't move, doesn't break, doesn't need refilling, and never once complains about the Wi-Fi. You're not selling a service, you're selling a locked door and a monthly reminder that you still haven't dealt with your dead grandmother's china set. Here's the number that gets people's attention. The average self-storage facility runs a net profit margin somewhere around 40%. For comparison, the average business across all industries limps along somewhere in the low 20s. A restaurant owner would sell a kidney for a 40% margin. A self-storage owner gets it by doing, structurally, almost nothing. There is no inventory to restock, because the inventory is your inventory. There is no product to manufacture, because the product is an empty room. It is, on paper, one of the most efficient profit machines in commercial real estate, and it works because the entire cost structure sits on the customer's side of the padlock. So why doesn't everyone just build one of these and retire? Because the business isn't really about the boxes, it's about getting to full. And once you understand what full actually means in this industry, the whole thing starts to look less like real estate and more like a very patient psychological experiment. The magic number in this business is occupancy. Most operators treat somewhere around 80 to 90% occupied as the point where the facility properly pays for itself. And above that, almost every extra dollar coming in falls straight to the bottom line because the fixed costs, land, staff, insurance, are already covered. Below that number, you're not running a storage facility. You're running an extremely expensive collection of empty rooms that you still have to pay taxes on. The entire business lives or dies on one metric, and that metric depends entirely on convincing a stranger that the safest place for their broken treadmill is a windowless box they will visit twice a year, forever. And here's the part that should genuinely surprise you. Getting a customer in the door is only step one. Getting them to leave is where the real business begins. Because self-storage isn't selling storage, it's selling procrastination with a monthly subscription. The average renter doesn't book a unit for 6 weeks during a move. Industry data shows the typical self-storage tenant stays for roughly a year or more, and a meaningful share stay for several years, quietly paying rent on a box of stuff they have functionally forgotten exists. You are not renting square footage, you are renting someone's unwillingness to make a decision. And unlike literally every other consumer decision in a person's life, this one renews itself automatically, every single month, without anyone having to think about it. That's not a bug in the business model, that is the business model. If this is the kind of breakdown you enjoy, go ahead and subscribe. It actually helps a lot. And there's a much stranger layer to this industry sitting right underneath the boxes. Here's the layer nobody explains. Self-storage operators have quietly figured out how to sell you insurance on your own stuff, inside their own building, and make almost pure profit doing it. Most facilities require tenants to carry coverage on whatever they're storing, and most tenants just buy the plan the front desk offers instead of shopping around. That plan typically generates something like $1 to $2 of pure profit per unit per month for the operator, on a product where the operator isn't the one taking any of the actual risk. It sounds small until you multiply it across a facility with hundreds of units, and then across a company with hundreds of facilities. It's a tiny tax on anxiety, applied at scale, and almost nobody who pays it ever stops to ask who's actually underwriting it. Then there's the pricing trick that would get you laughed out of any other industry: the bait and raise. New tenants get a discounted introductory rate to get them in the door. Then, quietly, every few months, the rent creeps up. Not dramatically, just enough that fighting it feels like more effort than it's worth, especially when the alternative is renting a truck, taking a day off work, and hauling 40 boxes of stuff I'll deal with eventually across town. The operator is betting, correctly most of the time, that your own laziness is worth more to them than a competitor's lower price is worth to you. Rental rates across the industry have actually been sliding recently as new facilities crowd into the same markets. But existing tenants, the ones already sitting on units full of stuff they haven't opened in 2 years, tend to barely notice. That gap between what a facility charges brand new customers to walk in and what it quietly charges people who are already locked in is one of the most reliable profit levers in the entire business. Now here's where it gets almost funny. This is, statistically, one of the most recession-resistant businesses that exists, and the reason is almost insulting to human nature. When the economy tanks, people don't stop needing storage, they need more of it. Divorces happen, downsizing happens, people move in with family and need somewhere to put a couch that no longer fits fits anywhere. During the 2020 downturn, occupancy across the industry actually climbed, at one point pushing past 90% nationally, while plenty of other commercial real estate categories were quietly falling apart. Self-storage doesn't need people to be thriving. It just needs people's lives to be in enough motion that they can't decide what to do with their furniture. Chaos is the product's best marketing department, and that is why Wall Street eventually noticed. This industry isn't dominated by mom-and-pop lots with hand-painted signs anymore. It's increasingly owned by a small handful of massive, publicly traded real estate investment trusts, the kind of companies that also own shopping malls and office towers, because a REIT investor doesn't actually care whether the box holds a filing cabinet or a Ferrari. They care that the box generates a predictable, boring, recession-resistant check every single month, with almost no maintenance and almost no customer interaction. Self-storage REITs have, in strong years, outperformed entire stock indexes, which is a genuinely strange sentence to say about an industry whose core product is a locked door and a hallway that smells faintly of cardboard. So take the whole thing and lay it out end to end. You buy cheap land nobody else wants. You build the cheapest structure in commercial real estate, 4 walls and a roll-up door, no plumbing required. You fill it using humanity's near universal inability to throw anything away. You upsell insurance on stuff you're not liable for. You raise the rent slowly enough that leaving feels like more work than staying, and then you sit back and collect a check that, unlike almost every other tenant relationship on earth, comes from someone who, statistically, will not set foot in the building for months at a time. It is, without exaggeration, one of the purest businesses ever built on the back of one very specific human flaw. We would rather pay forever than decide.